The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
So, Flight Centre has trimmed its FY24 profit guidance, forecasting underlying profit before tax to be in the range of $316 to $324 million for FY24. That is 130% growth on the prior year. The figure excludes $4 million in losses from its decision to close its Discover Central Americas division, its destination management business there. Total transaction value around $23.7 billion, which is in line with its FY19 result prior to COVID there. A $1.7 billion year-on-year increase despite, it says, airfare deflation. However, market not impressed. Taking a look at the stock today, it is down. Well, it's actually down further, but it has come back a little to be down 4% lower this morning. So let's get into what our experts think. Henry, what are your thoughts?
Well, I know the market's taking this as a downgrade, but you could equally take this as an upgrade as well in some respects. What they have done is tightened up the range. It previously was 300 to 340. The market has got itself into a bit of a tither, I guess, to some extent, because they've tightened the range up to 316 to 324. Now, 316 is bigger than 300, but unfortunately 324 is smaller than 340. So the market is taking it as a downgrade. At least that was the initial dump. I think it was down around 8%. We're now down around 4%. It has rallied up in anticipation of this. I have to say, it's not a terrible number. It is a tightening of the guidance rather than anything else. They are talking about airfares coming down, but sales going up. And I think, we've all seen that with anecdotally our friends traveling, and I'm no exception to that, overseas. And we have seen a reduction in those airfares. So I don't think this is a particularly terrible set of numbers in terms of guidance. And bear in mind, the stock has rallied from the bleak midwinter in June of around sort of $19.50 to $22. So we're only giving back some of those gains that we've seen in the last month or so. So I think nil desperandum with this one, and you can take it both ways to some extent. I'm just seeing this as just tightening the range rather than an actual downgrade to guidance. It's maybe a little bit disappointing on the top side of things, but equally it's a little bit better on the bottom side of things. So half glass full, half glass empty, market run hard. It's probably a hold at these levels.
Is it ever going to get back to those levels we saw prior to COVID?
Oh, no.
Yeah.
No, I don't think it is. I mean, that was extraordinary times. I think, the other problem that Flight Centre has got is still it's got an odd model, let's face it. In a world where we shop online, we buy our travel experiences online. I use my online people when I book my travel. I don't ever go to Flight Centre, and I certainly don't ever walk into a bricks and mortar store in terms of Flight Centre. So they do have still this odd kind of model where the world has transformed into an online marketplace, and Flight Centre still has this physical presence, which I guess is good for marketing and good for brand recognition, which clearly they like to do, but it does saddle them with higher overheads.
Luke, what do you think?
Yeah, I probably would reiterate some of the things that Henry just said, but I think the market did get sort of carried away, and a lot of analysts reporting about this this return to 2% profit before tax margins, which has kind of been the metric that management have been hanging their hat on. And again, today they've guided to that's where they're going back to, and maybe beyond. I think the market's kind of priced that downgrade's not probably consistent with that kind of messaging, and I think that's where the sort of 4% move in the share price down has come from. Like Henry said, I think on an aggregate numbers it's not such a big deal. I think what does it say about the business at a more micro level? I think there's questions there, and Henry's alluded to it. This is a structurally challenged business. The travel agent game, physical travel agent game, is an industry in decline. And as Henry said, he books his stuff through an online person. That online person's going on to Webjet most likely and booking through a wholesale, hotel and flight aggregator that's owned by Webjet probably. So, much prefer Webjet in the travel space. And I think we've talked about that a lot on this program before. But yeah, from my perspective, it's just too hard basket for Flight Centre. it's kind of priced at sort of 15-ish times earnings, like a sort of semi-growth business. And in reality, it's kind of a business in decline. And, when do you pick up the knife? I'm not sure. It might be a little bit too hard for me.
Sounds like a sell to me.
Don't know if I go as far as a sell on the current value. If management can deliver, get back to those margins, look, it might be worth paying a few dollars more for. Do I think, there's a lot on the table here? No. Do I think you could probably get similar exposure and, to the positive side of the market in travel elsewhere? Yes. Probably just lean to Webjet and sort of leave the structurally challenged stuff behind.
And there you have it. That is the assessment of our stock of the day, Flight Centre.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.